Assalamualaikum and hi everyone. I am Madam Yusna Liza Hamid. Welcome to my channel. In today's video, we are going to learn on how to prepare a consolidated statement of financial position for a simple group structure which involve a parent and a subsidiary. And this will involve a question coming from February 2023 FAR320. However, if you are learning also for other courses on consolidated financial statement, you would also find this helpful. So this is February 2023 FAR 320. Let's start. You have the information there regarding companies Charming that acquired shares and debentures in the company called Delightful. So Delightful is the subsidiary company and Charming is going to be the holding company, because you would notice later that the acquisition of shares in Delightful by Charming is more than 50%. And it was on the 1st of January 2020. So 1st of January 2020 is the date of acquisition. So 1st of January 2020. So 1st of January 2020, this is the date of acquisition. So just put a highlight there, the date of acquisition. And you have the statement of financial position, the separate statement of financial position of Charming and Delightful that needs you to consolidate them. And that was as at 31st of December 2022. And 31st of December 2022 is the reporting date, is the date that you will prepare your C-SOF-P, the consolidated statement. And therefore, this is the holding company, right? And this is the subsidiary. So let's see what we are required to do. So these are the information on non-current asset, current asset, equity and reserve, non-current liabilities and current liabilities of these two separate companies. And we are going to combine the result in a group financial statement. So let's see what you are asked to do by looking at the requirement. So if you look at the requirement, you are asked to prepare the consolidated statement of financial position of Charming and its subsidiary Delightful as at 31st of December. So you need to prepare the C-SOF-P and show the workings. Apart from just preparing the SOF-P, you also need to do this, number one, which is you need to go and calculate the goodwill and bargain purchase for each of the acquisition of shares and debenture that was given in the information. Number two, you need to go and prepare the schedule. The schedule here is to show the group reserve computation, which is to show the group reserve at the end of the current year, and also to show the total non-controlling interest at the end of the current year after you have acquired the subsidiary. And number three, then only you are going to prepare the consolidated statement of financial position. So meaning to say that don't just prepare the one in number three and leave the one in number one and two. So you need to prepare all that 3, 4, 30 marks, including the necessary workings and necessary maybe simple consolidation entries, as just to help you understand better the consolidation principles and issues that discussed here. So if you can see here, when we want to consolidate, we are going to actually add the asset and liabilities of the company together to become one. So the asset will be added before we do any consolidation. This will all be added. However, for the investment in subsidiary, you would see that this will not be reported in the consolidated statement. And this is actually the consideration transferred for each of the investment that were made by Charming. And that will be eliminated. So for the inventories, this will all be added. And you are going to do that first, which is to add whatever you have into your consolidated statement. I'm going to show you the template. However, for items like the debenture interest receivable, you may have to check if there is any elimination needed. Eliminate what? Eliminate any intra-group interest. Right, so if there is any. And then you need to go and check the information given here. The equity will also be shown, but you are going to show the share capital of the parent. The share capital of the subsidiary will be eliminated because it has now been acquired by the parent, and the remaining belongs to the non-controlling shareholder. So the portion will be shown in the calculation of goodwill, and that will be eliminated during the calculation of goodwill in the net asset and the non-controlling interest. Same goes for the preference shares. There are no preference shares of the parent, but you will have to eliminate the preference shares of the subsidiary. General reserve, this one we are going to do this by preparing the so-called schedule that I earlier mentioned. So you're going to compute the general reserve amount and the retained profit amount in the a consolidated statement using the schedule. And on top of that, you are going to have an additional item called non-controlling interest as part of the equity. The debenture, you are going to just show the debenture of the parent and the debenture of the subsidiaries, and you are going to eliminate the amount that was acquired by the parent. So there will be some adjustment here as well. Right, and then accounts payable, that you will see if there is any adjustment, we need to do that. Bills payable as well. If there are any intercompany bills that were undiscounted, we are also going to do the adjustment. So the same thing here. If there are any debenture interest payable related to the group members, related to the parent company, shared by the parent, that will also be eliminated. So let's look at how that is being done first for the part that was to prepare the template of the consolidated statement. So you can see here I have three columns. One is for the items or the particular. Second column is for the parent column, which is Delightful, the parent company. And you would see that the parent company is the parent company is Charming. The subsidiary company is Delightful. So we need to go and change that. So I put here Charming. And this one should be Delightful. Okay, right, this one is Charming. All right, and make sure you have a column for adjustment, yeah, to do the adjustment, and the last column will be for the total column that will have incorporated the combination of the asset and liabilities equity and together with any adjustment. So these are the group point of view, what are the amount that will be in the consolidated statement. So what you can do first is just to add the asset and liabilities as it is. So you can see here I have added and I put the land and building, all those things there. You can see I have put also new item here, goodwill, because later you will have to calculate goodwill or bargain purchase. In this question, you will get a goodwill. So we'll have to see how much is the goodwill and how much is the impairment. And for the investment in Delightful, I earlier mentioned to you that that has to be eliminated. So you have to go and first look at what are the investment that was made. So we will have to check later what are the percentage acquired for each of these different types of investment. But this will need you to eliminate. So you will have to eliminate this on consolidation. And for that, you are going to see that when it comes to the consolidated figure, it was 0. So basically, these are not going to be shown here because it is already eliminated on the acquisition. Right. And then the same thing should be done for the inventories, bank, receivable. Should just add them. If you have any figures, just put them into the correct column. And the ordinary shares, you will see that the ordinary shares of the subsidiary will be eliminated because the subsidiary was being acquired by the parent and the remaining goes to NCI. So you will see no ordinary shares of the subsidiary will be reported, and this will be just the parent only. So I highlighted here the parent only. Same goes for the preference shares. So you would see that there are no preference shares of the parent. If there is preference shares of the parent, therefore that should be included here. Right. Here is only the figure that you can see here is none because the preference shares is just the one of the subsidiary that has been eliminated. And for the retained profit and the group and the general reserve, what you are going to do is you are going to go and do the calculation by way of preparing the group workings in the schedule. So we're going to do that to find out the retained profit for the group and general reserve for the group using a schedule in our later part of the discussion. And on top of that, you have to include one new item, which is the non-controlling interest. That also will be calculated using the schedule. So we compute them using the schedule. On top of that, you have to also show the your debentures. So you can see that there are no debentures under parent. So we will just show the one of the subsidiary. So later we'll have to finalize what are the amount here. And the accounts payable, the accounts receivable, all this up until debenture interest payable will be added if you have anything. But you need to do some adjustment later. You can see that I have already included the total of the asset and liabilities here, which is 23,755,500, just to give you some idea of what would be the balancing amount. So let's go back to the statement and do what we have to do. So we have the detail there here regarding the acquisition of the information that was given in additional information number 1. We start with number 1. So number 1, you can see I'm going to use some red, some blue again, sorry. So the bought 3 million. So 3 million. So 3 million here is the amount acquired in ordinary shares out of 4 million ordinary shares. So if that is the case, you know that what was acquired was just more than 50%. So 3/4. So here is actually 75%. So that was done on 1st of January. So 1st of January is here. So that was the acquisition of ordinary shares, and you can calculate what are the percentage for ordinary shares. So if you have done that, you can do it here maybe, and we can also do the calculation. For example, here I can do it here. So where this one is OSC, for OSC, yeah, the acquisition would be 75%. Why 75%? 3 million out of 4 million, and therefore NCI would be 25%. So you can get that. And then for the preference shares, you would see that the preference shares acquired was 200,000 units of the preference shares. And let us look at the preference shares in the subsidiary. So you can see here preference shares in the subsidiary. The amount is 200,000. You are not informed what are the fair value, so you assume this is at 1 ringgit each. So the units is also at 1 ringgit. So therefore, you acquired the preference shares, 200,000 units of the preference shares. So 200,000 units of the preference shares, sorry, this is the consideration transferred. You should refer here, which is the preference shares in the subsidiary. It is here. So 1 million. So 200,000 units, and the preference shares is not given the information on fair value, but we assume this is 1 ringgit. So we assume the units are also 1 million units. So therefore, that will give you again the preference shares, 8% preference shares, to be 200,000 out of 1 million. So that will give you 20%, and this will be 80%. You will also do the for your debenture where that was also acquired. Debenture that was acquired is the 9% debenture. So 9% debenture, you acquire 400,000 of it. So 400,000, let's see what color can we use. So I use pink, which is 400,000, and the amount of debenture was 1.6 in the subsidiary. So 400 from 1.6 million, that will give you around 25%. So that was 25%. So I write here 25%. And there is no non-controlling interest, but the remaining belong to other debenture holder. So other holders will have 75%. Right. So you have also the detail here on the date of 1st of January, which is the date of acquisition again. And on that, the date of acquisition, you have the two balances of general reserve, and this figure is the pre-acquisition reserve. So this pre-acquisition reserve, general reserve of the subsidiary, the delightful, and retained profit of the subsidiary will have to be included in the fair value of the net asset calculation when you were trying to get your calculation of goodwill or bargain purchase. So make sure you include that if there is a calculation of goodwill that you will do later. So that was for number one. So that will affect goodwill. Now we go to number two. Number two is on information on fair value adjustment. So let us look at the information here. Fair value adjustment here is on the date of acquisition. Date of acquisition is here, 1st of January. So the fair value of land. So let's look at the fair value of land. So here, let's just draw a timeline, 1st of January 20. And the date that you prepare your consolidated statement is, again, to check. It was on 31st of December 2022. So this is 2020 here, 2021, and this is 31st of December 2022. So, okay, 2022, this is the date of acquisition. On this date of acquisition, you are informed the fair value of the land, was 6.16 million. While the fair value of the intangible asset, so this is on intangible asset, the fair value of the intangible asset was 360,000 higher than its actual carrying amount. So normally what you will do is you will compare the fair value with the carrying value. So the carrying value of intangible asset is not given. However, you are given straight away the information that it is higher. So the fair value of intangible asset, I just use PING, fair value was 360,000 higher than its actual carrying amount. So meaning to say that the question is telling you the information on the surplus, revaluation surplus, or surplus on revaluation. And that was how much? 360. So I put here 0.36 million. Right, so this is a pre-acquisition surplus. For the land, you can compare this to find out what are the surplus. For the land, if you go to the question, and you would see that the fair value of the land can be compared with the carrying amount of the land. And the carrying amount of the land, if you can see here, the land was 5.68 million. So if you compare that, you will be able to get the surplus of the land. Right, so that was for the land. And let us put that 5.68 million here. So you will compare and you will get the surplus. So go and find what is the surplus. But for the surplus on the revaluation of intangible asset, it was already given 0.36. So the fair value was not given. You need to find the fair value by taking the carrying value. So you need to find the fair value. How? Take the carrying value and plus back or add back the accumulated amortization. So you need to go and add back the accumulated amortization in order to find the fair value, because the fair value was not given. But the carrying value, you can find it by doing the calculation. So we can do this later. Like, let us look at the information further that is given, which is on amortization. For amortization, you are also informed the amortization period. Sorry about that. Amortization was another 4 years, and no adjustment was made to reflect that amortization in the financial statement of the subsidiary. So what you have to do now is to find out the first, what is the surplus. So for the surplus, yes, you know the surplus. You can do the journal entry for that. So this one is where you are going to debit intangible asset of Delightful, and you will credit asset revaluation reserve of Delightful, which is for the pre-acquisition 0.36 million. And don't forget, as I said, this must be included in the fair value of the net asset. So include this in fair value of net asset. You go and add them. Right. For the surplus of land, for surplus on revaluation of land, you can just take your calculator and find out what was the surplus on revaluation of land. So I've done the working here for that part. You can see the working here that I've done. Okay, let's just go to the working section here, right? For the land, you will have the revaluation surplus to be 480,000 if you take the figure just now, which is the one that I have mentioned earlier here. 6.16 minus 5.68. Yeah, so if you do that, you will be able to get that figure 6.16 minus 5.68. 6.16 million minus 5.68 million. So that was the one for land. So therefore, you need to go and adjust them in the non-fair value of net asset. For the intangible asset, earlier I mentioned it was 360,000, and now you need to go and find out how much is the amortization adjustment, because whenever there is a surplus, it means that the amortization that was provided earlier by the company here is the company is by the subsidiary here is Delightful. It is actually are being under provided. So from the date of acquisition, 1st of January 2020 to the current financial year end for 3 years, you need to go and find out what were the amortization that was being under provided, and therefore the the amortization need to be increased. To increase, you need to go and debit retained profit and credit the intangible asset. How? You will take the surplus 360,000 and divided by the remaining useful life 4 years. Where is the remaining useful life? The remaining useful life is actually here, the one given here. So after you have done that, you will multiply with 3 years because the amortization was under provided for these 3 years. So that is what you do here, right? So therefore, that should be included in the adjustment later when you prepare the schedule. However, for this part, which is the surplus of 360, that would be included in the calculation of fair value of the net asset. For your information, the remaining adjustment that you see here, yeah, which is in number 3 up until number 9, up until number 8, sorry, that would not affect the calculation of goodwill on consolidation. So for now, we can now prepare or calculate the calculation of goodwill. So let's do the calculation of goodwill here. So how do we calculate goodwill? I'm going to show you here. So in the first, all right, so you're going to, of course, the information earlier was already computed, but I just put it here. So first, for the calculation of goodwill, you can do the calculation in the schedule if you want. So this is a schedule which I just mentioned to calculate the goodwill and also to calculate the reserve and NCI. But we start with goodwill here. So I will calculate the goodwill in the adjustment column and in the goodwill column. The group retained profit and group general reserve column together with the NCI is the one that we need to have for our purpose of calculating the amount that we need to show in the CSOP later. So we start with this. The consideration transfer was given in the question where it was here. So we start with the calculation of goodwill. This figure, the investment in ordinary shares was 6.8 million. So the consideration transfer was 6.8, right? And just okay, then you need to go and find out what are the fair value of the net asset. So the fair value of the net asset will start with the share capital of the subsidiary. So share capital of the subsidiary should be the one given here. Okay, it is the share capital of the subsidiary. Take the share capital of subsidiary, and then you have information number 1, which gives you the information on retained profit. Take that retained profit on date of acquisition and put it here in the adjustment column. Then just now you just calculate the 2 revaluation surplus. One is from the land. Remember the one, the information number 2, and another one is the revaluation surplus for the IA, intangible asset. So that was on information number 2, the amount that we calculated or given in the question, 360. So this was calculated. So if you have total up, this will give you the fair value of the net asset. And the calculation of the non-controlling interest in the information, it was clearly informed that the non-controlling interest in number 9 is measured at the fair value of the net asset. So on the date of acquisition. So therefore, you are going to show that workings here. So to show the workings, you will have to take 25% from the fair value of the net asset. 25% here is 25% from 5480. Okay, which is that fair value of the net asset. And therefore, you will get the figure 1370. So if you can now find the first item, which is your goodwill on consolidation of ordinary shares. The second one is to find out the goodwill, if there is any, for the acquisition of preference shares. We'll do the same, find out the consideration transferred. This is from the information given in the figure here. So you can see here, I've taken this now, 200,000, right? To take that was the carrying amount of the preference shares, and you have acquired, the percentage acquired was 20%. So let's just do the calculation here. So the non-controlling interest would be taking this amount, right? And 200,000, the carrying amount of the preference shares, multiplied by 80%. So 200,000 multiplied by that, you have the carrying amount to be, let me just check, the preference shares was 1 million, sorry, 1 million. The carrying amount was 1 million. Yeah, right. So the preference shares consideration transfer was 200,000. So we have 800,000. Therefore, you will have 1 million. That will be deducted with the preference shares in the subsidiary that was 200,000, 1 million as well. And therefore, you have no goodwill. So there is no goodwill, nil, for the acquisition of preference shares. Next is the consideration transfer that you will use to calculate the goodwill on debenture. There is no goodwill on debenture, but we always need to double check. So for the goodwill on debenture, first take the consideration transferred and then look at what are the debentures that were being acquired. So the carrying amount was 1.6. So you will have to find out the consideration transfer you took from the question. And here the carrying value would be 400,000 because that was 25% from 1.6. So again, there is no goodwill. And you have another information for no goodwill. And here the total for the goodwill is going to be 2.69. And if you go at the bottom of the question, somewhere at the last item, second last, sorry, you are informed that the goodwill on consolidation, the figure that you just calculated, that goodwill was impaired by 10%. So the impairment here means that you are going to go and debit the retained profit of the parent company Charming to show the impairment loss. The impairment loss IL with 10%, which is going to be 269 because the goodwill just now was 2.69 million. So 10%, and you will credit goodwill. So if you do that, that will give you the impairment of goodwill. So that impairment of goodwill is going to be reflected here, right? Impairment loss, and the amount is 10% from 2.69 million, and therefore the remaining goodwill was going to be 2.421. So this is the one that will be shown in the C soft P later. This 269 will be reflected later when you calculate or show your workings for retained profit of the parent. You need to go reduce with this. Okay, done with that calculation of goodwill. Now let's look at the remaining adjustment. Okay, let's look at the second adjustment. We have done the first second adjustment, sorry. We are going to do the third adjustment. The third adjustment is on the intercompany sale of assets. So you are informed on in January 2022, which is in the current year. So this is the date of disposal. Delightful sold machinery, sold machinery. So if you have sold machinery, that was an intercompany transaction. Sold machinery to Charming. So Delightful is the subsidiary company. Charming is the holding company. And it was sold off for the figure here 180,000. So that was the proceed. So this is the proceed. I put here DP, disposal proceed. At that point of time, the carrying amount, you are informed the carrying amount of the machinery was 150. So the carrying amount, I will write here CA is 150. And the remaining useful life of the machine, remaining useful life on the date January, we assume 1st of January, it was 3 years. So therefore, what number one that you need to do is to find out what are the profit that you should eliminate, because this is going to be a situation of intercompany transaction, and therefore we will not report intercompany transaction. And if there is profit or loss arise on the intercompany sale of asset, that still remain with the buyer, we assume here it remains with the buyer, the machinery, so therefore we need to eliminate. So number one, what you need to do is to find out what are the profits. So to find the profit, what you need to do is you need to remove, as I said. So the profit here, you will compare the disposal 180 with the carrying amount. Carrying amount is 150. So you have a 30K profit. And this profit is an unrealized profit. Why unrealized? It is between group members, so you need to go and eliminate. To eliminate, you will go and debit that item and credit debit retained profit, and you are going to credit the asset here, machinery. So I've done the working here in my Excel worksheet, and at the same time you also need to do the adjustment for depreciation. So therefore the depreciation will also be adjusted. So if there is a profit, you will need to do the adjustment for over provision of depreciation. Here is over provision by the in the case here, who is the seller? The seller is Delightful. So Delightful need to adjust the over provision of depreciation. So let's look at that workings that I have prepared here in my working section here. Okay, that was number one. So this is the information that I just informed earlier. So why adjust the retained profit of the subsidiary? Because subsidiary sold the asset to the holding company, and the asset purchase still remains with the buyer. And then the elimination that need to be done is to debit retained profit of Delightful as we debit in the retained profit of the seller, 30,000. This is the working here. And you will credit machinery of Charming. So when you do this later in the work schedule, you need to go and remove that in the workings under retained profit. And for this crediting machinery, you need to go and remove them in the Cs of P. Then there will be a depreciation that was being over provided from the date of disposal until the Cs of P date. So meaning that from DOD, I put here, from DOD to the Cs of P date. So Cs of P date here is the date of consolidation. Right? So therefore, was only 1 year because that happens on 1st of January. So therefore, what you take is take 30,000, the unrealized profit, divided by the remaining useful life, 3 years. 3 years is given in the question, this one. 30,000 is the unrealized profit. So you will get 10,000. So therefore, depreciation has been over provided, meaning that your profit has been overcharged, right? So you have overcharged the profit. So therefore, you need to go and you have overstated, so understated the profit, right? You have understated the profit. So now you need to go and reduce the profit and go and add more to the profit. So you're going to add more to the profit. Credit retained profit of Delightful, debit machinery, because there is no depreciation account or accumulated depreciation given. So you will directly record the depreciation adjustment by reducing the retained profit since it was being over provided. So if it's over provided, you go and reduce the expenses. So when you reduce the expenses, you credit the retained profit. So when you credit retained profit, is because you want to reduce the expenses that was earlier over provided. So this should be adjusted later by adding back to the retained profit since earlier it was being depreciation was over provided. Later do that also in the soft P. Right, that was number 3. Now we move on to number 4. Number 4 is on intercompany sale of inventories. So again, you need to identify who is the seller, who is the buyer. Earlier, the seller is the subsidiary in the previous adjustment, and the buyer was actually the parent company. So let's look at this one where you have Delightful again, which is the subsidiary. The subsidiary is the seller, Delightful. And that happened in 2022. They sold inventory amounted to 400,000 to Charming. So Charming is the holding company, and this is the buyer. So what you need to find out is whether you are going to have any of the inventories that you bought, which is the one that sold between group member, does that still remain unsold by the buyer. So you have the information that 50% of this inventory still remain unsold with the buyer. You have no information about the amount owing whatsoever. So this is just the information telling you that maybe inventories was sold on cash basis. So 400,000 at a profit of 25% on selling price. So let's see that in our adjustment here, info number 4. So for the intercompany sale of inventories, that was a downstream sale because subsidiaries sell goods to the parent. Unrealized profit would be taking the 50%, which is before that it was a margin given. So 25% times 400,000, and unrealized profit is on unsold inventory. So you are informed earlier the unsold inventory was 50% will remain unsold by the buyer. So therefore, you would have to take 50% and times 400,000, and the margin was 25%, so 50,000. So this 50,000 was earlier charged to by the seller, right? When they sold the inventories. Now, for consolidation purpose, there was an intercompany transaction, so the profit must now be removed. To remove the profit, you will reduce the profit by debiting the retained profit of the seller, 50,000. And that would be credited to the inventories, 50,000. So this was to remove the unrealized profit. So therefore, you have to go and adjust in your working schedule later, your schedule for computation of reserve, and also adjust in the inventory by removing it from the inventory later, deduct from inventory. Next, we'll go on to the next item, which is our bills payable. So there is another one, intercompany bills payable. So you need to go and look at how much was the bills payable between group member that was undiscounted. So you have the bills payable of Charming, 90,000, which are due to Delightful. So this 90,000 is intercompany bills, and therefore Delightful has factored a quarter of the bill. So meaning to say that out of this, 1/4 was factored. So meaning to say the amount that was factored was 22,500. And we need to find out what was the amount that was not factored or undiscounted. So you find what is undiscounted. Undiscounted would be, of course, a quarter was discounted, so a 3/4 was undiscounted. So therefore, you will take 3/4 from 90,000, and that one would be the undiscounted bill. So undiscounted bill is 3/4 from 90,000. So let's just do the working for the undiscounted bill. So elimination of undiscounted bill, taking 3/4 of the amount that was not discounted or not factored times 90,000, 61,500. So this will not a difficult one. So it is debit bills payable that will affect current liabilities later, and credit bills receivables, because these are intercompany transaction that you must eliminate. Next, we go to the next item, number 6. Number 6 is on dividend. So for dividend, you need to identify whether dividend can fall under three situations: situation 1, situation 2, or situation 3. So if you can see here, this dividend is under situation 2. Situation 2 is where both parent and subsidiaries have not recorded or recognized the dividend. How do I know? Because you are informed the board of directors are proposing the dividend for the company. So the dividend proposed by Charming of 365,600 should appear under Charming's retained profit adjustment. So therefore, retained profit adjustment of Charming C will be debited with 365, this figure, 365. And number 1, so number 2 is that it will be credited to the ordinary dividend payable. So we'll be doing this in our next section in the working. So you are going to do that. The same thing should be done for delightful. So you are going to also record the dividend that was not recorded, because this is situation 2. Both have not recorded. Situation 1 is the both have recorded. Situation 3 is subsidiary has recorded, parent has not. So let's look at the case here. So for both situation, ordinary dividend and preference dividend, these are situation 2. Situation 2 where both have not recorded. So let's look at the one for ordinary dividend first. For ordinary dividend, if you provide the dividend, you debit retained profit, right? The amount is 144. So 144, so this is 144 given in the question. Credit or dividend payable 144. So this will appear in retained profit column of delightful, because that was declared by delightful and that was not recorded. So we record in delightful retained profit, and only dividend payable will be shown later in the current liabilities to be 144, but that was the one declared by the subsidiary. For the one in the parent also will recognize some of this dividend. So dividend declared by subsidiary will also be shared by parent. Why? Because 75% of the shares in subsidiary was acquired by the parent. So when subsidiary declares dividend, 144,000, 75% belongs to the parent. So parent will take some share of dividend from this 144, 108 belongs to the parent. So parent will credit the retained profit. Subsidiary will debit the retained profit with what they declared. So therefore, the what will not be reported will be the one that is due to the parent. And however, the one that will be reported in the consolidated statement will be the one due to the non-controlling interest. Second one is about the dividend paid by the subsidiary himself. The subsidiary Charming 365,600. Where do we get this? This is from here, given in the question. This is not subsidiary, it's the parent company. Let me check again. Okay, parent. To provide dividend by parent, the parent company Charming, subsidiary is the one that we have already done earlier. So there will be retained profit of Charming. So subsidiary declare, parent take the share, parent declare, so belongs to parent, 6,365,600. So that would be shown in the retained profit of the parent as an expense. This one will be shown as an income receivable. The next one is on preference dividend. So if you go to the question, you would see that the preference dividend is not given directly. So you need to calculate. For preference shares in the subsidiary, there are none. So there are no preference dividend, in the parent company. There is no preference dividend because there is no preference share. For delightful, you are informed there is a full year dividend. So to calculate the full year dividend, you will go and refer the 8% shares multiplied by 1 million. So do that, and that will be debited to the retained profit of subsidiary 10 million from 1 million, you get 10% from 1 million, you will get 80,000. Yeah, 8%, sorry, 8% from 1 million. So that should be there's a typo there. Okay, I just correct them. 8% from 1 million. So it will be 80,000, and that will be credited to preference dividend payable 80,000. So this will appear again in the subsidiary. So I just put a different color for subsidiary. Okay, right. Next one is the share of dividend by parent, because parent acquire how much was earlier? It was 20%, right? The preference shares acquired by parent. So therefore, the dividend that was declared here 80, 20% belongs to the parent. So that was 16,000. So this must be shown later in the schedule. So done for that. Later in the schedule, we need to incorporate all that. Next. The next one is our adjustment, which is our last adjustment, that is telling you on the debenture interest receivable. You are informed Charming has recorded its portion of debenture interest receivable from Delightful. So Delightful has already provided for debenture interest receivable. Charming also debenture interest payable was provided by Delightful. Charming has taken credit of its portion of debenture interest from Delightful. So therefore, this is situation number one. Yeah, both have recorded situation one. The second one was situation. So this was situation one. I put here both H and S, holding and subsidiary, have recognized. So when it has been recognized, situation one, you need to eliminate that intercompany dividend. So if you want to know how much, it was given here. The one declared by subsidiary was 144, declared by subsidiary. The one shared by parent is 36. How do you know it's 144? How do you know it's 36? 144 was given, right? 44,000. However, that 36,000 here is as a result of taking the 25% shares in the debenture times 144. So if you do that, you will get 36,000. So all 36,000 here must be eliminated. Why? Because they are intra-group dividend. So you need to go and eliminate intra-group debenture interest, not dividend. Intra-group debenture interest, you will eliminate. So that debenture interest receivable will have to be deducted when you prepare your consolidated statement. And this figure here, 144, you will have to remove with the 36,000. So that is to eliminate the intercompany dividend. And I'm showing it here, right? So debit debenture interest payable with 36,000, credit debenture interest receivable also with 36,000, because that is the share of the parent. So that will be adjusted in the cease of P later. That will not involve any adjustment to the retained profit, because that has already been recorded. So for the impairment loss, it is here. So we are done with everything. Let's just do the schedule first. Let's do the schedule. Put whatever you have done into the schedule. Remember to do very fast for your workings on let's say the adjusting journal entry. You don't have to be detailed. Just write simple journal that you can understand yourself. Okay, let's do this. Number one, before we can start, you make sure that you have this column again. Group retained profit, group general reserve, and the non-controlling interest. So my last column here is NCI. My second last column here is my general reserve, and my third column, last column here, my middle column here is my retained profit. So we start with this first, which is to find what is the non-controlling interest. This is from our earlier calculation here, which is this and this from our workings of Goodwill. Working of Goodwill, which is 1.37, and the one under preference shares 800,000. Okay, put it there. Now you create column, some row for Delightful. So for Delightful, which is the subsidiary, put the balance as per given in the question. So it was 1120. It was from here. This one. Now, then you go and put your pre-acquisition balance. Pre-acquisition balance is the balance on the date of acquisition. That was actually the figure here. This here, the figure here. 160. That was already included here, which came from here. This figure. Also include this general reserve balance in the calculation of general reserve later. Right? Then you get your item for your post-acquisition balance. Then you need to do adjustment. Remember information number 2 earlier was on fair value adjustment. We do the amortisation. That was 270,000. We debit retained profit of the subsidiary. You can check the adjustment that I earlier did. Right? And how do we get that? We take 70 divided by 5 times here 2 years, which is the information given here, in case you have forgotten. Where was it? Here, right? 4 years, sorry. Okay. And this is 360. All right. Divided by remaining useful life 4. And you will have to times 3. Okay, so that was 9 times 3. After 3 years, that was 270,000. So you can check the calculation that I've shown here. Yeah, this one, right? Okay. Next, information number 3, we have the intercompany sale of asset, machinery, by the subsidiary. So the one under subsidiary adjust under subsidiary, meaning that in the adjustment column, the one of the subsidiary, and then you have another one which is the depreciation over provided that you have done also in the working for information 3. Next one is the working for information 4, where subsidiary is still the seller. So the unrealized profit that you have adjusted is 50,000 you debit earlier. And the next one is the information 6, where you go and do the journal entry to record the dividend payable by delightful for order dividend. And then another one is preference dividend payable by delightful was 80,000. So 144, 80,000. So there are no more adjustment for the subsidiary. So we can total up the adjusted post-acquisition balance. Out of this 396,000, you would see that the one that would belong to the parent, which is under group profit. Remember, this is the column for group profit. This one would be how much? It would be 297, which is 396 times 75% percentage acquired. The remaining will go to the non-controlling interest, which is 25% from that figure that you have done earlier. So that was the 99,000. Next is to do adjustment for the parent company. First, start with the retained profit given as per the question, which is the one here in the question, in the statement of financial position, which is this one. Take that. Don't forget to later take note on this as well for the general reserve. Don't forget. So there is no not much adjustment here. One is the adjustment regarding ordinary dividend payable that we earlier did, right? When parent also declare ordinary dividend. There are no dividend declared for parent under preference shares, but there are dividend that are receivable from the subsidiary. You can see that what was debited to the retained profit, I reduce. What was credited to the retained profit of the parent, I increase or I add back. So you have received dividend from the subsidiary. For consolidation, you will not report, but here you are just doing the record. Right. Preference dividends payable from Delightful was 16,000. So you record the one that is shared by you, the parent. And the impairment loss that you earlier calculated here to 269 will now be adjusted to reduce the profit of the parent. So therefore, you will have to add up all that. So if you add up all that, that would be adjusted balance of the parent. So this is adjusted balance of the parent. So I just put here adjusted post acquisition balance of the parent. All right. So 14449. So you are going to include that in the group column. So the figure that you calculate here, you will include here. Next one would be the general reserve of the subsidiary. So earlier you have already been informed that you should take this from the statement. So 800,000 here, where is it? It is actually here. Yeah. And take that, deduct with this, the figure general reserve. Okay, do that. You have the post-acquisition balance. So it was not used for whatever bonus issue. So this is just the amount that you need to go and share. Give it to the parent. The one given to the parent would be group for the group is 240, 320 times 70%. And another one is 80,000, which is 320 times 25%. Then for the general reserve of the parent company, the total was 2.8 from the question, given in the question, 2.8 this one, and that would be included under the group general reserve column. So now you are done with all the calculation. You can total up those three columns, the last three columns, the blue, the green, and the orange column, and you will get the figure 17. For all these figure are the figure that you will show in the consolidated statement of financial position. So let's just put this straight away to the correct row. So you can see here, I've put the color here. So the figure that you get here is the figure from your working schedule, right? Now we can do the remaining. So go and post them correctly. Now we can do the adjustment. So for the land, you need to adjust further the land, which is with the surplus only. Remember, debit land of subsidiary. So debit add, then you adjust the subsidiaries plant and machinery with the surplus. You add the surplus, you remove the under provision of depreciation. So that was the case of uh, the plant and machinery. The plant and machinery, right? Next one is you have this one is not the surplus, sorry. This one is the over provision of depreciation. This one is the unrealized profit. So I have already confused it with the intangible asset. So this is the unrealized profit that we remove, and this is the over provision of depreciation. And then this one is the intangible asset that was over provided in terms of amortization, and this is the amount of surplus that was given. So therefore, this is actually the going to be the total intangible asset shown in the group. So for goodwill, you would see that at first the goodwill was 2.69, and you remove the impairment, you eliminate the impairment, you write off, that was 269. So write off 2421. For the orange shares, I've already explained that. So now go for the inventories. For the inventories, you would see it was 50,000 that you remove the unrealized profit, right? And account receivable, no changes because there are no intercompany balances that was amount owing whatsoever, none. So just add up. Bill receivable, you need to eliminate the intercompany bills that we have done, the undiscounted bill, unfactored bill. The debenture interest receivable, you will see no debenture interest receivable because all of these are intercompany debenture interest. Bank, you just total up, no other adjustment that is needed. Then you will be doing for the your non-current liabilities. Non-current liabilities, you will have to report only 1.2 because 400,000 was the debenture required. Accounts payable, you just add them up, no adjustment because none. Already dividend payable, the one that you will show here will be the one of the that was given here is 108. 365 is under the parent, and therefore 144 is by the subsidiary. So therefore you have the only dividend receivable should be eliminated. So what you report here is the one of the parent and the one paid by the subsidiary to the non-controlling interest. For the preference dividend payable, you have none under parent, but you have to report the dividend payable to the non-controlling interest, which is taking 80,000. Remember, we have done the calculation, minus 16,000, the intercompany preference dividend receivable by the parent. The debenture interest, you will just report the debenture interest payable to other debenture holder. Okay, that's it. That was about it. And I have also put some little notes on my right hand side in case you think it is beneficial for you. Maybe you can refer that. Yeah, you can refer that. But thank you for watching. I'll see you and I will see you. With that, have a nice day ahead and assalamualaikum and pleasant viewing.